Thank you. Welcome to the Wealthcast. And today I wanted to talk about rebalancing your portfolio. So, at Wealth Legacy Institute, May is a wonderful time for us, at a minimum, to drill down into each of the portfolios and each of the individual asset classes and determine if we need to make adjustments and get the portfolios back to their original risk tolerance. So let's talk about why is it so. First of all, let me specifically explain more why rebalancing, what is it, why it's important. So, when you think about picking your risk tolerance, your portfolio risk, you define it by how much you put in stocks, how much you put in bonds, and how much you have in cash, and in its most simplest format. So, when you think about say a 60-40 portfolio, that usually assumes 60% of your portfolio is in stocks or equities, and 40% of your portfolio is in bonds or fixed income, and then maybe a small sliver of cash. So, what happens is over time, oftentimes equities exceed what their original positioning is. And say from 50% or 60%, all of a sudden it's at 70%. So that means your portfolio is more at risk. And that's why it's important to rebalance and to have discipline around that. It's easy to kind of like let it slide because it feels good. You're making a lot of money. But then when there's a correction, as markets move in cycles, which there always will be, then you may end up being further exposed. So let's talk about it. So, rebalancing is about adjusting the weightings of the different asset classes in your investment portfolio. And this is achieved by buying and selling, like selling your winners and buying, quote unquote, the less performing assets to get it back up to its original percentage. It's kind of like it's kind of like a tune-up on your car. It allows you to keep your portfolio risk levels in check. So here's how we do it. We do it, as I said, at least once a year, and it's in May at a minimum. However, there are times, and we call them guardrails. So when we talk about portfolios going up and down, we have guardrails. So we have a top and we have a bottom. Most people think of guardrails on the bottom in a correction. And so several years ago, December of 2018, right around the holiday of Christmas and New Year's, the capital markets uh, corrected and went south. We did not rebalance. We almost rebalanced at that time, but it was only about a day or two, and then they popped back up, getting it back within range. So they never crossed over that bottom range that would force us to rebalance. Another time, you all know when that was in March with the pandemic. That was probably one of the first times in a decade that we actually rebalanced because of hitting the guardrails. So other than that, if we don't hit guardrails, then we rebalance at a minimum once a year and check each of the asset classes. So let's talk about it. What are the things that you need to consider when you rebalance? Because it's kind of a personal thing for each investment. And so it depends on the cost. If you have to pay trading fees, obviously your personal preferences, and of course the taxation considerations are very, very important. And what determines that is the type of account that you're selling from, of whether the capital gains or losses will be taxed. You have to consider whether it's a short term or a long term tax rate. So it also differs by your age. For example, if you're relatively young, say your 20s or 30s, you might rebalance less, often because you're willing to take on that risk versus someone nearing retirement and wants to make sure that they stay within their comfort level and can sleep at night. And so, how do you avoid taxes when rebalancing investments? There are a few things. Obviously, to avoid all taxes when rebalancing a portfolio, it means not selling any investments. So, how do you do that? One way to do that is using cash or new money to bring the underperforming asset class up to its original percentage. Instead of selling go go stocks to buy underperforming stocks, you use cash. That way, you're not creating a taxable event. Um, the other thing to consider is what type of investment is it? If it's an IRA account or 401k retirement account, you don't have to worry about capital gains taxes. So you just rebalance, and you can rebalance as often as you want if you don't have trade fees to do that. Um, but you want to make sure that it's kind of disciplined. Some people feel comfortable rebalancing quarterly, particularly in their 401ks. So those are things to consider. But the bottom line is your the more you help maintain your original asset allocation strategy and stay within your comfort level of risk, the more likely you are tied to a financial plan to stay the course. So essentially, rebalancing will help you stick to your investment plan regardless of what the market does. And when you have discipline around your strategy, you're more likely to have immensely better investment outcomes. And that's why we rebalance, and that's why it's so important to have discipline and an investment strategy. So fill me in on what works for you. And if you have any ideas or thoughts or questions around rebalancing, happy to answer them after this video if you want me to follow up later. All right, thanks for your time. So appreciate it. If you like this, please share it with those who may find it important. And thank you for your time.